So, January 2026, it feels less like a new year and more like a seismic shift in the crypto landscape.
It really does.
We're talking about everything hitting the industry at once. You've got these regulatory delays that just drag on, existential threats from quantum computing, and then massive institutional capital just swinging the market based on, pure macroeconomics
Right. If you're trying to track all of this, it can feel like navigating a minefield.
while wearing a blindfold. Yeah.
Yeah.
And you sent us an incredible stack of sources detailing these very developments from uh, the delayed U.S. market structure bill all the way to the launch of a quantum-safe Bitcoin testnet.
A lot to cover.
A lot. So our mission right now is to cut through all that noise, extract the core nuggets of knowledge, and give you actionable intelligence. We want you to be able to strategically position yourself for what's coming next.
And, when the market throws this much complexity at you, simply tracking news isn't enough. You need a robust framework to filter and prioritize. Exactly. We're going to decode these developments using what we call the Hive Block Strategy. Think of it as four core pillars that help transform these confusing market events into practical strategic decisions you can make today.
Okay, let's hear them.
So these pillars are education, which just means staying current on the underlying tech and the macro drivers. Then security, which is all about protecting your digital assets against evolving threats, and we'll definitely get into quantum computing there.
That big one.
A huge one. Third is diversification, which involves allocating across different assets, sectors, and importantly, different exposure methods. And finally, compliance, making sure you're navigating the complex and, frankly, fluid regulatory landscape correctly.
ESDC.
ESTC. Every development we discuss today will be filtered right through that lens.
Okay, let's unpack this and start where the uncertainty is, well, thickest. The regulatory waiting game here in the U.S. This delayed crypto market structure bill.
Right. This delay is a crucial signal, and it speaks directly to the nature of the legislative process.
What happened exactly?
Senator John Boozman announced that the Senate Agriculture Committee's markup of the big crypto legislation has been pushed back, delayed to late January 2026.
Okay.
But here's the important part. This wasn't a failure. It was a delay driven specifically by ongoing negotiations with legislators like Senator Cory Booker to ensure broad bipartisan support.
So why is the delay for bipartisan support so important? What does that signal about the compliance environment for you, the listener?
It signals a real commitment to clarity, even if it delays the outcome. The goal of this legislation, people are calling it the Clarity Act, is to establish clear jurisdiction, between the SEC and the CFTC.
It's a big fight.
The big one. And to provide solid regulatory frameworks for digital assets, for DeFi, and crucially for stablecoin issuance. The fact that they're pausing to get a comprehensive two-party solution suggests that when the framework finally emerges, it's going to be robust, it'll be less likely to be immediately challenged or, reversed.
That's the optimistic read, for sure. But for you, the individual investor, the delay just means the environment stays ambiguous. And we've seen this movie before, right? Major regulatory shifts just take time.
They absolutely do. And if we look at this through the education component, we have to recognize that legislative change moves at its own speed.
Glacial.
Often glacial, yeah, compared to technology. So what this means for your daily strategy is that while you await clarity, operational readiness is just paramount.
So let's apply the compliance lens to your holdings. What are the takeaways?
Okay, so three things. First, maintain detailed, unassailable records of all your transactions, and I mean all of them. Use robust tools like CoinTracker or Coinly, and use them religiously. This prepares you for whatever tax and reporting frameworks emerge.
Which is usually the first hammer to fall.
Always. Second, prioritize using exchanges that have already invested heavily in their compliance infrastructure. I'm talking about platforms like Coinbase, Kraken, or Gemini. They're just better positioned to handle immediate regulatory shifts.
What's the third?
And finally, think about how you're managing jurisdictional exposure. Don't let 100% of your holdings sit on U.S.-only platforms if you can help it. Diversifying your jurisdictional custody is a real way to reduce that concentration risk.
All right, let's talk about a risk that is far less ambiguous, but maybe far more existential: the acceleration of quantum computing. This went from a theoretical threat to an actual market event in a single day this month.
That's right. The timeline compression here is startling. On January 12th, 2026, exactly 17 years after the launch of Bitcoin BTQ Technologies launched the Bitcoin Quantum Testnet.
And this isn't just a white paper.
No, not at all. It's a functioning fork aimed at creating the first quantum-safe version of Bitcoin.
A quantum safe fork. Okay, what does that actually mean? For those who follow crypto, we know Bitcoin uses ECDSA signatures. So what is the technological defense they're deploying here?
They're replacing the vulnerable ECDSA signatures with something called NLDSA. That's the Module Lattice Digital Signature Algorithm.
Okay, break that down for the education pillar.
So, to put it simply, current cryptography relies on math problems that are really hard to reverse. Think like factoring very large prime numbers. Quantum computers, well, they can solve those problems easily.
Right.
Lattice-based cryptography, like MLDSA, it relies on geometry problems, but in higher dimensions. And for now, those remain resistant even to quantum attacks. It's a fundamentally different kind of hard problem.
And the urgency is magnified when we consider the scope of the exposure here.
It really is.
Yeah.
Estimates show approximately $650 to $750 billion worth of Bitcoin is sitting in addresses that have already exposed their public keys.
That figure is just staggering. And when you look at the recent hardware breakthroughs, Google's Willow chip, Microsoft's Majorana 1, it suggests the quantum threat is no longer a decades-out problem.
Exactly.
And then Vitalik Buterin's estimate of a 20% probability of breaking current crypto by 2030, that's still a low chance, but it's high enough to demand action today.
Absolutely. And this brings the security pillar into ultra-sharp focus. We are facing what's called the harvest now, decrypt later threat.
Explain that.
Adversaries are already vacuuming up current blockchain data transaction inputs, exposed public keys, and just storing it. They're waiting for the quantum computing power to become sufficient to instantaneously break those keys and steal the funds.
And the worst part is the immutability.
The immutability of the blockchain means once a vulnerability is exploited, the theft is permanent. There's no undo button.
So if I'm the listener and I have Bitcoin holdings, what is the single most crucial step I can take right now to mitigate this harvest threat?
The crucial strategic takeaway, the number one thing, is to never reuse a Bitcoin address.
Never.
Every single time you spend from an address, you expose its public key. That makes it vulnerable to this harvest now, decrypt later threat. Modern wallets, especially hardware wallets, are designed to automatically generate a fresh, unused address for receiving funds every single time.
So check your settings.
You must check your settings and verify this is enabled and functioning correctly. If you've been using the same address for years, those funds are potentially exposed.
That's a practical, immediate security check everyone should perform.
And beyond that, you need to elevate your long-term security model. Prioritize cold storage, especially hardware wallets where keys have never been used in a transaction. Evaluate your entire portfolio's quantum risk and start monitoring the migration timelines of projects like that BTQ testnet.
So this is coming.
It is. We anticipate that by 2028 or 2029, active migration of your holdings to these new quantum-resistant protocols might become an absolute necessity, not just a precaution. You need to be ready to move when the time comes.
Okay, let's pivot from existential technological threats to macro market dynamics, because this is where the money's flowing, and right now flowing out.
Yeah, we saw significant movement driven purely by macro sentiment this month. Over just a 4-day losing streak, we witnessed $1.3 billion flowing out of crypto investment products.
Wow.
And Bitcoin ETFs alone saw $405 million in weekly outflows. This wasn't a crypto fundamental problem at all. It was an interest rate problem.
So what was the driver?
The primary driver was the sudden collapse in expectations for Federal Reserve rate cuts in March of 2026. The probability dropped sharply from 44% down to just 26.2% after some hawkish commentary.
And when that happens,
When traditional financial institutions see higher for longer rates, they treat crypto assets just like traditional risk assets, and the money retreats.
so if we look at this through the diversification principle, this highlights a deep correlation risk. If institutional money using this ETF mechanism is causing Bitcoin to move in lockstep with the S&P 500 based on Fed policy, doesn't that fundamentally undermine the whole argument that Bitcoin is a true diversifier, an uncorrelated asset?
It absolutely does. And this is the mechanical insight you need to have. The ETF structure relies on authorized participants, or APs, who create and redeem shares based on institutional demand.
Right.
So when macro sentiment turns sour, meaning interest rate expectations climb, these institutional trading desks sell ETF shares. This forces the APs to redeem shares and sell the underlying BTC to meet that outflow demand.
A direct link.
A direct link that ties crypto to the volatility of traditional risk assets. And yeah, it severely diminishes the expected diversification benefit.
Okay, that explains the downside. But we have this huge bullish counter thesis emerging at the same time. Standard Chartered is projecting Ethereum will reach $40,000 by 2030. They're expecting it to significantly outperform Bitcoin over the next 4 years.
This is where we really need to apply the education lens to understand the differentiation. The bank still has its, $500,000 target for Bitcoin, seeing it as digital gold. But the Ethereum thesis is all about its utility.
So how does that play out?
They predict Ethereum's ratio to Bitcoin will climb from roughly 0.03 today back toward the 2021 high of 0.08.
So what are the unique catalysts driving that aggressive ETH target, especially when you compare it to other earlier ones?
It really boils down to four distinct advantages, and they're all centered on institutional adoption. First, its dominance in real-world asset tokenization, RWA.
Right, taking assets like real estate or bonds and putting them on the blockchain.
Exactly. We're talking corporate bonds, private equity funds, and Ethereum already dominates this market with over $10 billion tokenized.
Okay, what's next?
Second, stablecoin infrastructure. It hosts the majority of the world's fiat-backed digital dollars, which makes it the transactional backbone. Third, the planned technological improvements, specifically the roadmap for achieving 10x throughput increases in the next few years.
That's a big deal.
Huge. And finally, the anticipated regulatory clarity from that Clarity Act we mentioned, that's expected to provide a solid, predictable framework for the DeFi mechanisms that run in Ethereum.
Okay, so we have BTC being pulled down by ETF outflows tied to the Fed, and we have ETH being driven up by this forward-looking utility thesis tied to RWA and DeFi. What's the strategic path for balancing these two?
This is pure diversification in action. First, you have to understand that short-term, macro-driven volatility creates exceptional buying opportunities for long-term dollar-cost averaging.
DKA.
You have to separate your trading mindset from your holding mindset.
Good advice.
Second, you must now monitor macro indicators like the CME FedWatch tool and the 10-year Treasury yield. They're no longer just traditional finance data. They are significant volatility drivers for your crypto portfolio.
And in terms of allocation.
Right. Third, build a thesis-based allocation. Do you favor Bitcoin for its robust monetary premium and its institutional hedge status? Or do you favor Ethereum because you believe RWA tokenization, that merging of traditional assets with blockchain, will be the dominant financial trend?
And for the ETH holders.
Finally, if you do allocate to ETH, you have to understand its scaling dependency. Its throughput relies on layer 2 solutions like Arbitrum, Optimism, and Base. And don't overlook the passive yield opportunities either. Reliable, low-risk staking can generate around 3–4% yield directly on your holdings.
That brings us to our final development, which is the undeniable convergence between Wall Street infrastructure and the crypto space itself. Traditional finance, or TradFi, is integrating deep into the plumbing.
The Morgan Stanley filing is probably the starkest evidence of this institutional pivot. They filed with the SEC to launch ETFs tied to both Bitcoin and Solana prices.
The inclusion of Solana there is incredibly significant.
It really is. It signals institutional recognition of a layer 1 beyond just the BTC-ETH duopoly.
So why Solana specifically? Why not, Cardano or Polygon? What's the institutional ELI 5 for that decision?
It comes down to utility and institutional readiness. Solana offers very high throughput and extremely low fees, which is critical for institutional market makers running complex, high-frequency creation and redemption strategies.
So for the institution filing the ETF?
For them, Solana is viewed as the most battle-tested, high-speed transactional network currently available outside of Ethereum's ecosystem. Simple as that.
And it's not just asset management, right? We also saw World Liberty Financial, which is backed by the Trump family, apply to the OCC for a national trust bank charter.
Yeah, focused on stablecoin issuance and digital asset custody. It's a convergence across all layers of the financial stack.
So if we connect this back to our ESDC framework, what's the play here?
This convergence is simultaneously about enhancing compliance and security. Traditional entry increases market legitimacy, and it provides a kind of regulatory insurance for investors. But there's a strategic trade-off.
Which is?
As banks issue stablecoins and manage custody, the price formation mechanism shifts further away from organic on-chain activity. Price will increasingly be dictated by these institutional creation and redemption baskets, not by retail traders or native DeFi flows.
So given this new reality where TradFi kind of owns the access points, what are the final strategic decisions for the listener?
You have to evaluate your custody trade-offs very carefully. Buying an ETF offers regulatory insurance and simplicity, but you entirely sacrifice asset sovereignty and the ability to earn yield through staking or lending.
And the other side?
Direct custody means full control and yield opportunity, but you assume all the security risk yourself. Your choice really has to align with your personal security comfort level and your investment horizon.
And for those looking at Solana now,
You have to understand the technical risks. Increased legitimacy doesn't eliminate inherent technical weaknesses. It has a history of network outages and concerns about validator concentration. Those are critical faux pages. Security considerations you must weigh before you allocate. And lastly, prepare for seamless bank-supported fiat crypto bridges.
Meaning,
As more banks secure these stablecoin charters, the ability to move fiat in and out of the ecosystem is just going to become faster and cheaper than ever before.
this has been an incredibly fast and dense deep dive. We've covered seismic shifts in regulations, security, and institutional dynamics, all hitting us in just the first few weeks of 2026.
And we navigated all of them using the Hive Block Strategy. We focused on education by understanding that new mechanistic link between macro indicators and ETF flows.
Right.
We covered security by implementing post-quantum awareness with that address reuse rule, diversification across assets and exposure methods like the ETH and RWA thesis, and compliance by ensuring readiness for this delayed regulatory marathon.
The power of the framework is clear. It takes complexity, regulatory delays, quantum fears, macro outflows, and it gives you a consistent, robust set of rules to react strategically.
And that's the key. Successful participation isn't about predicting every single twist and turn. It's about building robust frameworks like ESDC that perform consistently and help you build strategic positions across diverse, unpredictable scenarios.
So what does this all mean? The final thought we want to leave you with builds on that institutional integration theme. If institutional flows increasingly dictate price action through these ETFs, what responsibility do you have to maintain the decentralized core of the assets you hold?
That's a great question.
Does your chosen exposure method, buying an ETF versus, say, staking, running a node, or engaging in native DeFi, does it reflect that responsibility? The future of finance is being written in real time, and your strategic positioning today determines your participation tomorrow.